stop for a moment. Markets did not crash today because of panic selling alone. Something deeper triggered this fall, and most investors are reacting to the noise without understanding whether this threat is temporary or something that could last. Today, the Indian stock market fell sharply as global trade fears returned. The Nifty 50 slipped by around 0.85%, reflecting rising concern among investors. At first glance, this looks like a normal correction, but the real trigger lies outside India. The center of today's market fall is a renewed tariff threat backed by US President Donald Trump. This threat has revived fears of a broader global slowdown and trade disruption. The concern comes from a proposed US law called the Sanctioning Russia Act of 2025. This bill allows the United States to impose tariffs as high as 500% on countries that continue to buy Russian oil and energy products. India is directly exposed here. India has increased its Russian oil imports in recent years to manage fuel costs and inflation. Even though this law is still only a proposal, markets are reacting early. Such a move could significantly disrupt global trade flows and hurt exporting nations like India. What makes investors even more nervous is that this is not the first trade action against India. The United States has already imposed tariffs of around 50% on certain Indian goods earlier, linked to the same Russian trade concerns. These higher duties have already started impacting some export segments, with reports of slower shipments and reduced demand from the US. Because of this existing tariff, the 500% threat feels real to markets, not just political talk. Markets always react to uncertainty before policy changes actually happen. The United States is India's largest export destination. Any sharp increase in tariffs would make Indian goods more expensive there, directly hurting demand and company profits. This fear is why investors began cutting exposure to riskier, cyclical sectors today. Sector performance clearly shows that fear went beyond oil. The metals and mining sector fell over 3%, making it the worst performing sector of the day. This reflects worries about weaker global growth and lower demand for industrial metals like steel, aluminium, and copper. The Nifty Oil and Gas Index dropped close to 3%, as uncertainty around Russian crude, future sanctions, and global supply weighed on sentiment. The hardware, technology, and equipment sector declined nearly 2%, showing concerns around global trade, exports, and capital spending. These companies are highly sensitive to tariffs and manufacturing slowdowns. Interestingly, metal stocks fell more sharply than oil. This tells us investors are not just worried about energy supply, they are worried about demand destruction. When trade tensions rise, global manufacturing, construction, and infrastructure activity tend to slow. Since metals are closely linked to economic growth, even the fear of a slowdown can hit metal stocks early and hard. Because metals, oil, and industrial stocks carry significant weight in the index, heavy selling in these sectors drag the broader market lower. That is a key reason why the Nifty 50 closed down around 0.86% today. Foreign investors are also turning cautious and reducing exposure to emerging markets, adding further pressure on Indian equities. Now comes the bigger question: is this threat permanent? At this stage, the tariff risk is more about risk perception than immediate damage. But markets never wait for clarity. They price in worst-case scenarios early. That is why volatility may continue in the short term as news around US trade policy, elections, and geopolitical tensions evolves. Before we go further, if you like market moves explained without panic and rumors, like, follow, and subscribe. We post such real market stories every day. For long-term investors, India's domestic growth story remains intact. Infrastructure spending, manufacturing push, and consumption demand are still supportive. However, global shocks like this can trigger temporary corrections even when fundamentals remain stable. Final takeaway: today's market fall is not just about oil. It is about rising global uncertainty triggered by the 500% tariff threat, especially when a 50% tariff is already in place. The sharp fall in metals, oil, and industrial sectors shows that investors are preparing for slower global growth and tougher trade conditions. Until clarity emerges, markets may remain cautious and pressure on cyclical sectors could continue. End thought: markets react first, understanding comes later. The real edge lies in knowing the difference.